For the 2026 tax year, the IRS has set a specific dollar amount, $16,100 for single filers and $32,200 for married couples, that represents the largest automatic reduction of taxable income available to the majority of taxpayers. This is the standard deduction. When the IRS calculates your federal income tax, they subtract this flat amount from your total income before any tax brackets are applied. The higher the deduction, the lower your taxable income. The scale of this deduction has changed significantly over the last decade. Prior to 2018, the standard deduction for a single person was $6,350. That baseline changed with the 2017 Tax Cuts and Jobs Act. This legislation nearly doubled the deduction to $12,000 for single filers, effectively shielding a larger portion of a typical worker's earnings from federal tax. While those changes were originally set to expire, the One Big Beautiful Bill was signed into law to make these expanded deduction amounts permanent. To account for the rising cost of living, the IRS adjusts these numbers annually using the Chained Consumer Price Index. The exact figures for 2026 were formalized in Revenue Procedure 2025-32. Knowing these specific 2026 figures allows you to calculate exactly how much of your paycheck is protected by law before you begin your tax return. According to the 2026 tables, single filers and married filing separately receive a $16,100 deduction. For married filing jointly, it is $32,200. For head of household, the 2026 deduction is $24,150. These amounts are limited for those who are claimed as a dependent on another person's return. In these cases, the 2026 deduction cannot exceed the greater of $1,350 or $450 plus the individual's earned income. If we look at a single filer earning $55,000, we subtract the $16,100 deduction immediately. This leaves only $38,900 as taxable income, which is the actual figure used to determine your tax bill. Certain taxpayers are also entitled to an additional standard deduction. This applies specifically to those who are legally blind or those who are age 65 or older by the end of the tax year. For 2026, the bonus amount is $1,650 per person. This amount is added directly to the base deduction, meaning a single filer over age 65 would subtract a total of $17,750 from their income. Confirming your correct filing status and age eligibility ensures that the baseline tax calculation uses the highest deduction available for your situation. The next step is a simple comparison. Should you take this flat standard amount or itemize individual expenses on Schedule A? Itemizing involves totaling three main categories: state and local taxes up to the legal cap, your annual mortgage interest, and your total charitable donations. The rule is strictly mathematical. You only itemize if the sum of these expenses is higher than the standard deduction for your filing status. First example, a single renter has $4,000 in taxes and donations. The $16,100 standard deduction is higher, lowering their tax bill. Second example, a married couple has $41,000 in total expenses. This outweighs their $32,200 standard deduction, so itemizing provides the better outcome. Because the standard deduction has been increased so significantly, approximately 90% of American taxpayers now find that the standard deduction provides the larger tax break. Applying this math test determines whether you need to maintain detailed records for Schedule A. If your expenses don't meet the threshold, you can focus on other sections of your return. You claim this on the first page of Form 1040. Checkboxes at the top indicate if you are a dependent or qualify for the age-related deduction. On line 12, the standard deduction is subtracted from your gross income before final taxable income is determined. There is a specific trap for those who are married filing separately. If your spouse itemizes their deductions, your standard deduction is legally reduced to zero. In this scenario, both spouses must use the same deduction method. If you're 65 or older, check your 1040 to ensure the additional $1,650 was applied. Your expenses are higher than these baseline amounts. If you are currently filing your 2025 return, remember that those figures are slightly lower than the 2026 numbers we've discussed: $15,750 for single and $31,500 for married. Our next video will focus on how the brand new $6,000 senior deduction from the One Big Beautiful Bill interacts with these standard amounts for retirees. This information is for educational purposes. For individual tax advice, you should consult with a certified public accountant or an IRS-enrolled agent. By confirming your 2026 deduction amount now, you can project your tax liability with higher precision and ensure you are only paying the amount required by the current tax code.